Welcome back, everybody. There is a new report out showing loan modifications are rising faster than they were a year ago. Diana Olick joins us right now with more on that front. Hi, Diana.
Hey, Becky. Yeah, as pain in commercial real estate drags on, most acutely in office, and the prospect for significantly lower interest rates is pushed further out, we're now seeing a big uptick in modifications. In the first quarter of this year, there were $1.42 billion in office loan modifications. That is a huge jump from the just $117 million in the same quarter last year. And all of this is according to a new report from TREP. Analysts there say that is not a good sign for the market.
It may put a Band-Aid on the current environment that we're in, but it really just transfers the risk down to future years where, borrowers are hoping interest rates are lower, they're hoping occupancies are stronger. But the reality is in 12, 18, 24 months, which is the typical extension has been, I don't see a lot of changes happening.
Borrowers have to pay a lot for these modifications, and the terms are very short. The incentive had been for lower interest rates, but that's not happening now as quickly as most thought. So looking forward, there's less incentive for additional modifications. Not a good sign for lenders also holding the bag like Bank of America and Wells Fargo.
And so if they start getting the keys back, I would expect some additional government intervention or some sort of stimulus or some sort of public-private partnership to really try to save and stimulate that side of the CRE equation.
Now, TREP expects loan modifications in office to increase through the year as there's about $30 billion worth of maturing CMBS office loans left in 2024. Overall, CMBS delinquency rates surged in April to the highest level in 2 years. Becky?
Hey, Diana, that's been the big question. We've known that there were going to be, if not modifications, if not lower interest rates, that there were going to be lenders who had to, or borrowers who had to walk away, hand the keys back over. I think the question becomes this idea of whether there needs to be government intervention or not, or whether there's enough other private money on the sidelines willing to come in at much lower prices. We talked to Mark Lasry recently, and he was saying there really aren't the deals there yet, that hasn't happened. But it won't be until you actually see some of these people saying, forget about it, capitulation and throwing in the towel, unless the government intercedes. What would be the reason the government would want to intercede? Because the banks are in so much trouble?
Well, yeah, I mean, it depends on how much is sent back to the banks, how many how many borrowers walk away. We talk about this extend and pretend, and people say there's a lot of dry powder on the sidelines, just like you said, waiting to buy some of these distressed properties. But some of the, borrowers aren't going to be able to do that given what kind of debt they're in. A lot of these properties, they have, very, very, very big debt on these. And so they're going to hand the keys back. And then it becomes, can the banks sell them off to those investors on the sidelines that are waiting, and at what prices, and how much is the pain? And I think that determines whether the government has to step in.